Welcome to Capitalism That Works, a series co-produced by GlobalTreehouse and Jesper Koll. And in today's session, I want to talk about some of the things that concern me about Japan. There's a lot of great things going on, but there are obviously some issues as well. And the single biggest issue that concerns me is money, and in particular, the way the Japanese central bank is actually interfering in the Japanese economy. This is an enormous place of financial socialism. And let's step back a little bit. As you all know, central banks around the world are growing their balance sheets very aggressively. They did so after the global financial crisis and during the COVID crisis. But Japan has been doing this for basically one generation. And it's very, very interesting when you look at Japan, you find that the amount of the growth in the central bank balance sheet has completely decoupled from economic activity. And just look at the numbers. Since 1998 until now, Japan's GDP, the Japanese economy, has grown by about 12 trillion yen, but the Bank of Japan's balance sheet has grown by 600 trillion yen. And what that means is that in 1998, 1 yen from the Bank of Japan supported about 7 yen of the Japanese economy. Today, 1 yen from the Bank of Japan supports only 0.7 yen of the Japanese economy. So more money, less economic growth. Obviously, the balance sheet growth by the central bank has had some other impacts in asset markets here in Japan, but in terms of monetary policy being a leading indicator or creator of economic growth, this has not been very successful. Now, the biggest beneficiary of the central bank buying all that government debt has, of course, been the Ministry of Finance. And the Bank of Japan today basically owns about half of all the public sector debt that is outstanding, which is an incredible amount. And you can see that with the central bank having become such an active buyer of government debt, that despite the amount of debt having surged and more than doubled, the interest expense, so the cost of servicing that debt, has actually continued to come down. Total public debt in Japan is about 1,000 trillion yen, but the cost of servicing that debt is less than 7 trillion yen. So it's less than 70 basis points to carry one of the largest amounts of debt the global economy has ever seen. So that's an enormous intervention that has actually happened. But the really interesting part is not the Bank of Japan buying government debt, because the Federal Reserve is also buying US government debt. The ECB, the European Central Bank, is also buying European government debt. But Japan is special and unique in the sense that the Bank of Japan also buys Japanese equities, Japanese shares. And this, the Federal Reserve and the ECB do not do. And in fact, the intervention, the buying by the Bank of Japan in the Japanese equity market has become so large that now Japan's central bank owns about 10% of all the equity outstanding here in Japan. This is a de facto nationalization with the government through the central bank owning 1/10 of corporate Japan. And this is concerning for two reasons. The first one is it goes counter to good governance and capital stewardship reform. And second, nobody knows how the Bank of Japan can ever get out of this enormous amount of equity ownership. Let's look at the governance issue at first. Well, the Bank of Japan owns 10% of the equity, but will never attend a shareholders meeting, will never vote on any of the management, because those shares are held in ETFs, and as a result, they are a passive holding. And that, of course, goes completely contrary to everything that the Japanese government, the Tokyo Stock Exchange, and the GPIF, the Government Public Pension Fund, have been trying to do, which is to activate a better and louder voice from shareholders to put pressure on Japanese management. So the governance issue implied by the Bank of Japan's massive ownership of ETFs is one concern, and it goes counter to what the government is trying to do on other aspects of its policy. The second, more practical concern is that nobody knows how the Bank of Japan can rid itself of those shareholdings. Remember, when the Bank of Japan or the Federal Reserve, when you own a bond, the exit is very easy. All you need to do is wait until the bond matures, and then it rolls off your balance sheet. With an ETF, with an equity ownership, you actually have to sell it. But if you sell it, surely the market is going to crash. So the trick is, the Bank of Japan needs to find a stable buyer. And who is that? Right now, nobody knows, but there is only one answer, in my opinion, which is Japanese retail, Japanese individual investors. And as you know, about 70% of all the financial wealth is held by people over the age of 60. If you're over the age of 60, your biggest concern is inheritance tax, which in Japan is very high at about 55%. So one possible solution for the Bank of Japan would be to offer its ETF, its shares, for Japanese retail and allow for those shares, if they are bought, to become exempt from inheritance tax. That way, you could create a stable owner and a smooth exit for the Bank of Japan to clean up its balance sheet. But that's just a proposal at this point. It is very controversial, and we are nowhere near. So in the meantime, when I talk to global investors and to Japanese investors about investment strategies in Japan, the first question I always get is, when is the Bank of Japan going to sell? What type of distortion is the Bank of Japan equity buying program causing in the Japanese equity market? So that's an issue that Japan will need to address if it really wants to become capitalism that works. Thank you very much. This is a series produced by GlobalTreehouse and Jesper Koll called Capitalism That Works. We hope that you will join us for some of the other sessions. Thank you very much.